Bitcoin is sitting at $63,704, and the chart is screaming something that most people are too distracted to hear. Here's the thing about this price level. On the surface, $63,704 looks like dead money, down 2.8% on the week, barely a tick in the last 24 hours. If you pulled up the chart and didn't know any better, you might close the tab and go look at something more exciting. That's exactly the reaction this market wants you to have. Because right now, Bitcoin is forming one of the tightest, most deliberate consolidation patterns it has put together all year. And the last two times it did something like this, it moved 30 to 40% within 8 weeks. The setup is simple, but it's real. Bitcoin has been grinding sideways between 61,000s on the low end and 66,500s on the high end. Every time it dips towards $61,000, buyers show up. Every time it pushes towards $66,500, sellers cap it. That's not weakness. That's a battle, and one side is about to lose. The question is which one? And that's what we're going to break down today. Now, before we get into the levels and the catalysts, let me give you the quick version of why Bitcoin matters in your portfolio in the first place, because some of you watching have heard the pitch 100 times and tuned it out. Stick with me for 60 seconds, because this framing changes how you read everything that comes after. Bitcoin is not a tech stock. It's not a company. It doesn't have earnings calls or a CEO who tweets too much. What it is a fixed supply monetary asset. There will only ever be 21 million of them, roughly 19.7 million of which already exist. Every day that passes, the remaining supply gets harder and more expensive to mine. Think of it like owning a piece of land in a city that keeps growing but can never build new land. The city gets more people, more demand, same amount of land. Price goes one direction over time. That's the core thesis. Simple, stubborn, and so far, correct across 15 years. Now here's where it gets interesting in 2026 specifically. The halving that happened back in early 2026 cut the daily supply of new Bitcoin in half. Historically, the 18 to 24 months following a halving is when the price makes its biggest moves. We're sitting right in that window. And if the historical pattern holds even loosely, the math gets uncomfortable for anyone sitting on the sidelines. If this breakdown is clicking for you, subscribe to Crypto Sayans. We break down moves like this before they go mainstream. Let's talk about what institutional money is actually doing, because this is the part retail investors almost never hear about. On-chain data right now shows long-term holder supply. That's wallets that haven't moved coins in over 155 days, sitting near all-time highs. At the same time, the amount of Bitcoin sitting on exchanges is at multi-year lows. Coins are leaving exchanges at a pace that doesn't match the price action you'd expect. When coins leave exchanges, it means people aren't planning to sell. They're moving to cold storage, to custody solutions, to vaults. That's accumulation behavior, not distribution. BlackRock's Bitcoin ETF has continued to pull in steady inflows throughout 2026. Fidelity's fund is right behind it. These are not speculative retail plays. These are pension allocators, sovereign wealth managers, and family offices who went through a multi-year due diligence process and landed on Bitcoin as a portfolio hedge. When that money moves, it doesn't move fast and loud, it moves slow and quiet. The chart you're looking at right now might be reflecting exactly that. So here are your levels. Watch $61,200 as the critical floor. That's where the 200-day moving average is currently converging with a major horizontal support zone. If Bitcoin loses that level on a weekly close, the picture changes and we could see a flush down toward $56,000 or even $52,000. That's the bear case and you need to respect it. On the upside, $66,500 is the line. A clean break above that level with volume behind it, not just a wick, a real close, opens the door to $72,000 relatively quickly. Above $72,000 and we're looking at all-time high territory with $80,000 and beyond back in play before the end of 2026. Some of the more aggressive institutional models are targeting $90,000 to $100,000 by mid-2027 based on post-halving cycle compression. That's not a guarantee, but it's a serious analysis from serious people. Now the honest risk. Bitcoin is not a sure thing. never has been. The macro environment in 2026 still has teeth. Interest rates, dollar strength, and any surprise regulatory moves from Washington or the EU could all hit the price hard and fast. We've seen 30 to 40% drawdowns in the middle of bull markets before, and they will happen again. If you're using leverage or money you can't afford to lose, this is not the vehicle for that. The people who actually build wealth with Bitcoin are the ones who size it correctly, don't panic on the dips, and zoom out. Also worth noting, the $61,000 support holding is not a guarantee. If macro conditions deteriorate sharply, think a surprise Fed move or a major geopolitical escalation, that floor cracks fast. Have a plan before you need one. So here's my take. At $63,740, Bitcoin is not a screaming buy and it's not a sell. It's a watch with a trigger. If you're already holding, this is not a level that warrants panic. The setup is still intact and the accumulation data supports patience. If you're looking to add exposure, the smart play is to define your risk first. What level invalidates your thesis? And can you hold through the noise if price dips towards $61,000 before it moves higher? If the answer is yes, the risk reward here is one of the better entries you'll find in this cycle without chasing a breakout. The coil is tight, the catalysts are real. The institutions are quiet for a reason. Subscribe to Crypto Sayans. We break down the top coins every week so you never miss a move. Hit the bell too, because when Bitcoin starts moving, it moves fast, and you don't want to catch it on the recap.